Welcome to Closing Day. My name is Jeff Delgrand and I'm your host. Closing Day is a show all about real estate. We cover everything on this show from buying, selling, buying with no money down, renovating, appraising. We cover it all. What we hope you get from this show is some education, some entertainment hopefully, but mostly get some tips, get some information that's going to help save you time, save you money, and make your whole real estate experience that much more enjoyable. Now, today's show is Real Estate by the Numbers. And I have with me today Ted Pollock, a chartered accountant, who's going to help us out and make this really interesting about how real estate by the numbers will run. Now, this is something people don't know much about, is how does the accounting, the number side, all that stuff of real estate work? In other words, what does an accountant see when it comes to my house?
Only the painful stuff. No.
All right.
Well, thanks for having me on the show, Jeff. What we look at as an accountant is real estate. Every time you buy or sell real estate, that's a taxable event, and you got to do something about it.
Right.
And most people don't know that. And the one that affects pretty much everybody, because most people anybody that owns their own home, there is a tax issue. Yeah. And what I'd like to make everyone aware is that for the last 2 years now, it's official. You must report the sale of your personal residence on your tax return.
There's a spot to do that?
Oh, yeah.
Oh, okay.
There's the bottom of, it's called Schedule 3 on your personal return.
Yeah.
Don't want to bore you with that, but the thing that people need to know is that it was always optional. It was never required administratively, even though it was a taxable event often, that you'd elect out of it with an exemption. Boring, but the reality is now you must put the sale of your home on your tax return. And if you don't, the key is that you got 3 years from the date you file for them to reassess you. If you don't put it on, you're opening yourself up for 20 years later. They find out that you own a second property and that you claim the principal residence on the second property. They'll go, hey, wait a minute, you owned another property 20 years ago that you didn't elect on, so we're going to get the tax on that plus 20 years interest.
No way.
Oh, yes.
Yeah. Because I thought like your personal residence is, any money you make on that is supposed to be tax-free, correct?
It is, but you only get one residence a year and one residence between a husband and wife, or common law. And so, so you designate it as what you call the principal residence, and it's Section 45(2) of the Act, and you get one every year. And the key things to qualify for it is that you have to ordinarily inhabit it throughout the year, or during the year. Pardon me, whoops, I made a slip there. You have to do it during the year, which means you have to live in it for 1 day each year. So if grandma is now in the old folks home, but you still kept the family home, you got to check her out for a day every year to live in her house to keep the principal residence exemption alive.
Really?
Yep, 24 hours. And I do that also with separated spouses. I have them go back to their house and live in it for a night, and then move out again. And then when they sell it 4 years later, they claim the principal residence exemption for their part. So that's the one thing. Now, the other thing that people don't know about principal residence, I mean, you can get into, you can have any size of house. And like Frank Stronach has a house that covers several acres. Plus a half a hectare of other land around it, which is about an acre. But that's the easy part. I mean, I can get into some technical stuff with that. But the other thing is that it can be your house. It can be a cottage. It can be a sailboat. It can be a mobile home. There's a rule that we call it the ESD test.
Right.
If you eat in it, you sleep in it, and take a dump in it, it's your house. It qualifies as a house.
This is an accounting term, I take.
Yes. So maybe your tent trailer won't qualify. Although, hey, we won't go there. That's for late night parties. So, but and the other little, just another little twist on it is that the house does not have to be in Canada. You can elect on your Florida property as your principal residence.
Really?
Yes.
And you can do a property a year, like?
Yeah, property a year. Now we're getting into the new topic here. So, one, you have to report your house.
Yeah.
Two, condos and condo flipping and house flipping, which is very prevalent, Highway 9 and South. Okay, I'm not saying Highway 9 in Orangeville, but definitely in Toronto and Vancouver, house flipping has been very common. Revenue Canada knows about it.
Okay.
And virtually, if if you go to put a purchase offer on a property that hasn't been built and you don't live in it,
yeah,
and the ESD test is a good start, but you should also get your driver's license updated, get all your mail sent there, and please contact Revenue Canada to give them the address of your house.
Oh, okay.
Because they always forget to do that. And literally make it your home, right? And then you sell it, then it could qualify. But they are aware of it because builders will do that. They'll build a house,
yeah,
live in it for a year, and sell it as a principal residence and move on to the next one. If they see a pattern of somebody changing their address every year for a couple of years, they will go back and look at you. Okay?
What, they could possibly tax that as a business?
They could tax it a business. The other, well, they can tax it as income on the gain on the sale of the property.
Okay.
And that's the house flipping part.
Right.
Now, another little interesting tidbit about house flipping is when you sell real estate, it could be considered a capital gain, of which half of it's taxable, or income. Everybody wants a capital gain.
Right.
And the word on the street, the rumor is that Revenue Canada in Toronto does not know how to spell the word capital gain.
Oh, okay.
Every time they see a condo flip, you file half of it as income. They come back and say, nope, 100% of it's income. And then they look for a bunch of tests to see whether you actually had the intention of ever moving into the property. Okay?
Okay.
There's a very long answer in behind that. Talk to your accountant.
Talk to your accountant.
But they're aware of it. Okay.
Okay.
Yeah.
So if you own a house that has a business attached to it and it appreciates, how does that work?
Okay, well that's interesting. The answer is that your principal residence has to be your personal residence. And when you put a business inside of your residence, there is an issue of whether the entire house still qualifies as your personal residence when you sell it. That's what we're talking about.
Okay, so if you have a home business, like you're an accountant working out of your house, for example, and I know you have an office, but if someone's smaller and just has an office at their home, or if they have a secondary office and it happens to be in their home, and they write off that portion of the house, okay, so what happens?
They can. So that the interesting parts of it are, the basic answer is how much of the house is being used for that business, number one. As soon as you get north of 30-40%, half of the house being used for a business, they're going to start to say, well, look, when you sell that property, we're going to say that half of that property was used for a business. Okay? If you use 10%, typically by law they can say, look, 10% of that sale price is taxable, but typically they ignore it and people don't file it as part of it being a gain on business. But the second one is how you identified that as your office space.
Right.
Revenue Canada's a bit anal about this. They want a self-contained room that walks and talks and looks like an office. It's got filing cabinets, it's got chairs, it doesn't have a couch, it doesn't have a big screen TV, it doesn't have a fold-out bed, although my office, but anyway, for sleeping overnight. But I mean the answer is that it has to be an office, and you have to see your clients there on a regular basis.
Oh.
And just for fun, talking on the phone does not qualify as seeing clients on a regular basis. There was a court case on that recently.
So someone has to physically come to your house?
Yeah, you have to have regular appointments there with your clients. I had a psychiatrist who saw a few patients a week in his home because they were uncomfortable going to his office.
Right.
And we wrote off that room in the house, and it was a self-contained room and all that. It was disallowed.
Why is that?
Well, it was at the tax audit level, and they probably wanted us to take it into court. Going into tax court is $10,000 a day. The tax deduction we were looking at was only a few $1,000s. It wasn't even worth the time. But that's how anal they get. But getting back to the main point is, if you have a sign over your door, Ted's Accounting, and with the neon sign flashing, and it's got its own parking lot and things like that, well, you've literally altered the features of the home.
Yeah.
And so there's two things that happen. One is you can write off those features of the home and depreciate it, whereas normally you cannot, and still get your principal residence exemption. But when you go to sell that home, that part of that house is going to be taxable. Okay? I want to just touch on that, by the way. Do not take depreciation on your principal residence, or you will lose the exemption. If you take $1 for 1 year and you own the house for 20 years of depreciation, called CCA or capital cost allowance, you lose the exemption. And the entire 20 years is taxable.
Now, your accountant would know this, right?
Yes, or better have good liability insurance. One or the other. But the answer is yes.
So $1 depreciation, 20 years worth of appreciation, you can lose that all.
Yeah, well, you can pay tax on all of it.
Yeah, well, the CRA does need some money,
I've heard rumors.
Trudeau's redoing his house. We've talked about financing that. We know he doesn't qualify, but somehow he's going to get the funding to redo his house. Yeah. So
the other things are that when people get into multiple properties, a house and a cottage, but I could talk at length about that. What would you like me to talk about?
Well, this cottage thing is interesting to me, partially because cottages are now changing. We think of a cottage as a house that's sitting on a lake, but now a lot of the, let's say the Graying generation thinks of the cottage as a condo downtown Toronto.
So, correct. There's no such thing as a cottage in the Income Tax Act. A house is a house is a house. Or their phrase is principal residence or residence, or residential property or real estate. Okay, those are the tax phrases. So the answer is that you can have as many pieces of real estate as you want. You can have as many residences as you want.
Yeah.
You only get to sell one of them or designate one a year as your principal residence. You don't do that until you sell that property.
Yeah.
And that's why you have to file it on your tax return. But my answer is that when you have a house, home and a cottage, or a home and a second property, that's when you decide.
So when you're filing a tax return every year, do you have to put your house and your cottage on this tax return every year?
Excellent question. No, you don't have to put either on it.
Okay.
But of course, you're going to have one of those as your address because you want Revenue Canada to know that you live there.
Okay, yeah.
But after that, no, you don't have to tell them anything until you sell the property. And then it's a taxable event. And you have to do something about it. You have to act.
So that's when you have to report it on your tax return.
That's correct. And what people have been doing, they have a house and a cottage. They maybe hold the family cottage for 20 years. And they sell their house 3 or 4 times. And what they're doing by not reporting anything is they were tacitly saying that house was my principal residence. So I've already used up all those years. All those years with that cottage, no exemption. And so now you're going to pay tax on the sale of that cottage.
Do you pay it like as income tax, regular income tax?
You just put it on your personal tax return with all the rest of your stuff, your salary, your self-employment income, your pension income, your interest. You just add it all there, and it adds up to line 150 is what the line is, and that's what you pay your tax on.
You would? Okay, so if you're paying tax on, say, the sale of a cottage, actually, I have some questions that I'll run by you after the break. I won't do it just yet.
Okay.
But just to get you ready, I will have a question which will be, what would you suggest, or what would you think would be sort of the top 1 or 2 tax tips for people to help save the money? All right, we'll be right back after this. This is Jeff Delgrand from Closing Day. We'll see you shortly. Welcome back to Closing Day. I'm Jeff Delgrand, your host, and today I'm with Ted Pollock, Chartered Accountant, and we're talking about real estate by the numbers. Now, Ted, something I wanted to cover quickly was the HST, when someone buys something new. Yes, I bet you have. just a quick synopsis of how that's handled.
Well, it's the home buyer's rebate that you get because the builder has claimed they call them input tax credits. Basically, the builder, all the materials that they've paid HST on, they get to claim it back. And so Revenue Canada says, well, the builder got to claim it back, so we want you to pay it. And so when somebody builds a new home or substantially renovates, and the good news is they're pretty liberal about substantial renovation. You do a renovation to your house, you could be subject to HST.
Mm-hmm.
That's a long stretch. You basically have to take it down on the foundation and put it back up.
Okay.
But then you're subject to HST. But so a new home, so you buy a new home in a subdivision,
Yeah.
you can get a home buyer's rebate on it. And that one, the builder can explain it to you. You can assign that amount to the builder and let them file for it and put it against your purchase price. You can get it back yourself.
Yeah.
But the fun one is when you are buying a house for the first time and they want the parents on to co-sign.
Oh, okay.
And there's been some interesting court cases recently. One was in Quebec, actually, where that situation happened. Revenue Canada said, look, the parents don't qualify for that. But they proved that the children were the only people living in the home, and they still got the home buyer's rebate.
Even with a cosigner?
Even with a cosigner.
Oh, okay.
Very interesting. For me, anyway.
Yeah. There's lots of parents that co-sign for their kids these days because, let's face it, for someone getting into their first home, quite often it's bank and mom and dad that's helping them out.
Well, I understand. I think in Orangeville, the average house price is $650,000 here. It's some number like that.
Okay. It was. I don't know what it is today.
The starter home.
Yeah.
So, which I remember we could buy a house for $65,000. I'm that old.
Yeah.
Unlike you, Jeff. We grew up together.
Yeah.
I let it in. Okay, but so getting back to this. So you get the parents are asked by the children, or more importantly by the bank.
Mm-hmm.
You don't have enough collateral. We want the parents' name on it.
Yeah.
And so the two issues are, do I get the home buyer's rebate? And the answer is yes, but there's a court case.
Yeah.
Even though Revenue Canada will tell you no, because they actually said no, and the taxpayer won.
Right.
The other one is, now the kids are living in that house, paying all the bills, and yet mom and dad are on title. Who gets the principal residence exemption? And the answer is, if you can prove that you're the one that lives there, you're the one that paid all the bills,
right,
and that you only had mom and dad signing on that mortgage and title, because in order to get the financing, get the letter from the bank as well, let them say that,
right,
then the kids will get the principal residence exemption and not screw up mom and dad's principal residence exemption, who have a house in Toronto that went from $300,000 to $2 million.
Yeah.
Don't want to pay tax on that.
Oh, that's good to know.
That's quite important, by the way.
Yeah.
But this one is so important. The taxes are so huge there that you want to talk to your accountant about that before you do that. Okay?
That's good advice. I get that question quite often, so I'm glad that you covered that one for us.
No problem.
Now, investment properties. People are starting to get to that point now where they're interested in real estate. Real estate's done well for quite a few years. Mm-hmm. They'd like to buy an investment property, maybe as their nest egg for down the road. Mm-hmm. How does that all fit into the tax picture? Well,
I have gray hair because I have a lot of clients that have had rental properties over the years.
Okay.
They have no hair, by the way. So, rental properties.
Yeah.
I absolutely love rental properties, but the gray hair part comes in the tenants. And so the number one rule of tenants is get good tenants, and the second rule is get good tenants, and the third one is get good tenants.
Right.
The other thing is, on the business side, on the financing side, is you want a property that can carry, and that's very difficult in this market. And what I mean by carry is that you put in money to buy it, plus you put in financing, and you're paying the property taxes and the insurance as the owner, and you want the rent to cover those costs.
Right.
Okay. Plus capital expenditures. Okay.
Yeah.
So investment properties, I really like them. Now, I want to tell you why I like them, and it's not because I'm an accountant. It's that there's only very few things that are pensions that are indexed. Your CPP is indexed. Your old age security is indexed.
Right.
If you're lucky enough to work for the government and get a government pension, it's indexed. The rest of us know.
Right.
But the other one is rental income. Rental income is indexed to inflation.
Oh, good point.
And so if you get a property that you buy today, and over 10 or 20 years, you've paid off the mortgage, now it's mortgage free, you've got good tenants, and it's generating income every year.
Yeah.
You get to raise the rents every year or two because inflation goes up.
Yes, yeah.
You can't do that with your mutual fund portfolio.
No, I don't want to talk about mutual funds at all.
No, I get another day.
But
so I like rental properties.
Indexed investment,
that's one hidden benefit of it. You have to file a form on your tax return. It's T776, rental property. The biggest problem that people have is they don't track the purchase price of the property, and they don't track the major expenditures, because you want to keep that cost base as high as possible, so that when you sell it, you pay tax on less. Okay.
All right. So expenditures, renovations.
Renovations. A bit on renovations. There's two things I want to mention to everybody is, if you have an investment property, is it a repair so you can expense it, or is it a capital item so that you cannot expense it? You have to add it to the cost. Well, the simple answer is, if you repair or replace it, expense it. The dollar amount doesn't matter, and Revenue Canada has put that in writing. What it is if you improve it, make new, to upgrade for technological reasons, then they'll say, no, that's an improvement to the property, so you have to capitalize it. So if you resurface the asphalt in your driveway and say pay $2,000 or $5,000 for it, you can expense that, because all you're doing is resurfacing the asphalt.
Right.
Or if you're redoing the roof shingles, you expense it, even though it could be $20,000. Okay.
Okay.
The second one, so that's on capital. That's on people that own investment properties. For the rest of us who only own one house,
yes,
the thing I see with most people is they don't keep the receipts on all their major expenditures. And normally the one is the cottage. You know, it's like, oh yeah, the brothers all got together and they built it 40 years ago. And then Bill put in the dock and Sid put in the gravel in the driveway.
Right.
Nobody keeps receipts. And I mean, the ones that didn't pay cash for everything, which is illegal, or it's not illegal to pay somebody cash, but they normally don't report it. They don't give you a receipt, which I don't like as an accountant, by the way.
Okay.
Even though I hate Revenue Canada, but but my answer is you keep those receipts, because you want that cottage cost base to be as high as possible, so that the gain on when you sell it for what your cost is smaller. You want that gain to be as small as possible to pay the least amount of tax. Okay.
So that'd be the same advice on an investment property. Anything that's not your principal residence, I guess.
Even if it is your principal residence, just in case you get an inheritance or inherit a cottage, or you get a second property, you never know what twists and turns come in your life. And you're going to go, yeah, remember when we added that addition, that sunroom onto our house 20 years ago? Do you know where those receipts are? And you're like, nobody keeps those receipts. My answer is keep those receipts.
Really? You can't just go back to your bank statement and show there's a payment?
That's a good start.
Okay.
Revenue Canada wants original receipts. Or in this case, because everything's grease paper now, scanned receipts are fine. But they want a receipt.
Oh, okay. All right. Okay. So all the major receipts especially, right?
Yep. Yeah.
Great.
So.
Okay. Now, we were talking about tax tips.
Yes.
Okay. So.
Well, the tax tips. So for most people, the biggest one for us accountants is interest expense and the deductibility of interest expense. When you own your principal residence, you cannot deduct the interest.
Right.
Unless you have a business purpose to the property or part of it. So if you rent it out, if you have a business in there, you can deduct that portion of the mortgage as interest. Okay.
Okay. Yeah.
But that one's not great. The deduction's okay, but it's not that sexy, and you got to be careful of your principal residence rules and stuff.
Right. Right.
The sexier one is, now I've built up some equity in my home. You know, I bought this house for $300,000 and it's gone to $700,000.
Yeah.
And now I've got a really savvy mortgage broker who's telling me I can get financing, I can get it refinanced.
Right.
Well, the key test on deductibility of interest is not where the money comes from, it's what it's used for.
Oh.
So it's where you put the money. If you put it into something that could potentially earn income, like the stock market, which definitely potentially earns income, even though we've had the best run in the last 50 years right now.
Yeah.
But the reality is that it doesn't have to earn income, but if it's got a chance to earn income. So if you buy a property, if you buy another property that's a rental property, you can deduct it. If you buy into the stock market, you can deduct it.
Yeah.
Raw land, interesting topic. That's a whole different topic, actually.
I mean, you couldn't buy raw land and deduct the interest on that?
No, but raw land's a different beast because it depends on the nature of how you want to use the land. Is it residential land? Is it commercial land? Is it farmland?
Oh, I see.
If it's land for development, you're allowed to capitalize what they call soft costs, which includes interest expense, property taxes, and then legal fees, legal and accounting fees related to that land.
Servicing, things like that.
You got it. Plus, for land for development.
Yeah, so someone wants to buy a lot and build a house on it.
But then when you sell it, though, land for development, it's all income because now you've basically told the government that I was using it to develop. Oh, that's a very tricky area of tax law.
All right, but if you're buying a house, if this, you own a house, your principal residence, you bought yourself a lot because you're going to build your dream home there, how do you handle the taxation of that?
Well, the answer is that typically what you'd say is, look, you can't write off the interest. And as you would know as a mortgage broker, it's almost impossible to get financing on raw land.
Yes.
So typically you don't have financing on it. So it's not as big a concern.
Right.
But the answer is that the costs associated with that land while you're waiting to develop it, keep those costs. Like if you have to keep, if you have a small building on it, you might have insurance. If you got property taxes, you will. Keep that receipts. But typically you can't add them to the cost base. Okay. So. So it's raw land's a little tricky one. My answer on that one is talk to your accountant when you've been doing that. Okay.
All right. So to summarize, what just we only have a few seconds left. What would you give for a few quick tax tips, or what would you say were the most important ones we touched on today?
Most important ones? I was going to say egotistically, go see your accountant.
That's probably really good advice. We did cover a lot of ground on this today, and the principal residence part was brilliant. That's something that
well, thank you.
Well, I get that question a lot, especially when you have parents helping their kids out, things like that. So you said the number one tax tip was?
Well, the number one tax tip was about interest expense.
Right.
And then the second one to me would be capital expenditures versus repairs. Okay, that one's a very interesting topic for everybody has them. So is there something we can do with them? And then the third one is investment properties.
Perfect.
And those would be my 3 tax tips today.
All right, we got to wrap up. Okay. Thank you very much for coming on the show, Ted. Thank you very much for viewing the show. Jeff Delgrand from Closing Day. See you next time. Cheers.